Mutual funds are one of the simplest ways beginners can enter the investment world, but most people in Ghana don't understand what they are or how they work. You don't need to be a millionaire, a stock market expert, or a financial professional to start investing. In this video, you will learn everything you need to know about mutual funds, from how your money is invested to how you can get started safely.
Unlocking Africa's Wealth Code, Money Code Africa.
Let's start with the simplest explanation. A mutual fund is a pool of money collected from many investors and managed professionally. Think about it like this. Imagine 1,000 people each contribute 1,000 Ghana cedis. Together, they create a 1 million Ghana cedis investment fund. Instead of each person trying to decide which company shares I should buy, which bonds I should invest in, when should I sell, a professional fund manager manages the money on behalf of everyone. The fund manager uses this combined money to invest in different assets such as government treasury bills, government bonds, corporate bonds, shares of companies, other approved investments. Each investor owns a portion of the fund. A simple real-life example is, imagine Ama is a young worker in Accra. She saves 500 Ghana cedis every month. After 1 year, 500 Ghana cedis times 12 months is equal to 6,000 Ghana cedis. Instead of leaving the money idle, Ama invests it in a mutual fund. The fund manager combines Ama's money with thousands of other investors and invests it. If the investment performs well, Ama's money grows. If the investment performs poorly, her investment value can decrease. The important point to note here is, Ama does not need to personally buy 20 different investments. The mutual fund gives her access to a diverse portfolio. One may wonder, how does mutual funds work in Ghana? Let's break down the process. Step 1. Investors contribute money. People invest different amounts depending on their financial ability. A real life example is, Kwame invests 1,000 Ghana cedis. Akosia invests 5,000 Ghana cedis. A businessman invests 100,000 Ghana cedis. And all their money goes into the same investment pool. Step 2. The fund manager invests the money. The professional manager studies the market and decides where to allocate the money. For example, a balanced mutual fund may invest 40% government bonds, 30% treasury bill, 20% company shares, 10% cash reserves. The goal is to balance growth and risk. Step 3. Your investment gains or loses value. Your returns depend on how the investment performs. Example, you invest 10,000 Ghana cedis. The fund grows by 12%. Your investment value becomes approximately 11,200, which means you have gained an extra amount of 1,200 Ghana cedis on top of your investment. However, investment fees and market conditions can affect the final amount. This means there could be charges when you decide to withdraw your amount. In simple terms, as an investor, before you invest in mutual funds, you would wonder, who regulates mutual funds in Ghana? How do I know my money is safe? In Ghana, mutual funds are regulated by the Securities and Exchange Commission Ghana, SEC for short. The SEC Ghana provides rules and supervision for investment companies operating in the securities market. This means investment companies must follow regulations, provide disclosures, and operate within legal requirements. However, investors must understand something important. Regulations do not remove investment risk. A regulated investment can still rise or fall depending on market performance. That is why understanding the investment product before putting your money in it is very important. I want to go ahead and tell you the different types of mutual funds that we have in Ghana at the moment. Number 1, money market funds. This is usually where many beginners start. The market funds invest in short-term investments. This is usually where many beginners start. Money market funds invest in short-term investments like treasury bills, fixed deposits, short-term securities. A practical example is, Yao wants to keep emergency money but wants better growth than a normal savings account. Instead of leaving 5,000 Ghana cedis in the bank account, he invests in a money market fund. The money can potentially earn returns while still remaining relatively accessible. This particular investment is best for beginners, emergency funds operators, and short-term goals. Number 2, fixed income funds. Fixed income funds focus on investments that pay regular income. Practical examples include government bonds, corporate bonds, and real-life example. A teacher wants steady investment growth over several years. A fixed income fund may suit someone who prefers more stability compared with investing entirely in stock. So this investment means You want to invest over a very long course of time, but you also don't want to elevate your risk. Mutual fund number 3 is equity funds. Equity funds invest mainly in company shares. Example, instead of buying shares from only one company, the fund may invest in many companies. If those companies perform well, the fund can grow. However, if the stock market falls, the investment value can decline. This type of investment is best for people who want to invest long term and people seeking higher growth in their money. Mutual fund number 4 is what we call the balanced funds. Balanced funds combine different investments. This type of investment combines the other 3 I've talked about. A balanced fund may contain stocks from growth, bonds for stability, treasury bills for safety. This approach tries to give investors a middle ground between risk and reward. You might be wondering, why do you need to invest in mutual funds? And here are some simple reasons. Benefit number 1, you can start small. Many people delay investing because they believe I don't have enough money. But wealth is built through consistency, and mutual funds offer you that starting point. An example is someone investing 300 Ghana cedis monthly for years can build significant wealth through discipline and compound growth. Benefit number 2, professional management. Most people do not have time to study financial markets every day. This is why fund managers will analyze economic trends, interest rates, companies, investment opportunities on your behalf so that your job can be easier. All you need to do is to pay that investment manager a premium. Benefit number 3, diversification. One of the biggest rules of investing, don't put all your eggs in one basket. Imagine buying shares from one company. If that company's shares perform badly, your money suffers. A mutual fund spreads your money across different investments, and this will help make sure you don't lose all your money at a go. It keeps your investment safe. Whilst one investment is falling, another might be rising, and it gives you the much-needed cushion you need, especially when you are a beginner. Over the course of talking about investments on Money Code Africa, there is one thing that has never left my lips: the risk of investing. And here are some risks of mutual funds. Many people make the mistake of thinking mutual funds are guaranteed money. They are not. Every investment has risk. And the first risk is the market risk. The investment value can fall. The value of your investment can fall. So it means if you put 5,000 Ghana cedis there, the value can fall all down to 1,000 cedis, 2,000 cedis or something. An example to help you understand this better is a fund invested in a company shares may decline during a market downturn. Risk number 2 is what I call inflation risk. Your investment needs to grow faster than inflation. If price rises faster than your investment returns, your purchasing power decreases. The next one is choosing the wrong funds. Different funds have different goals. A short-term goal may require a different investment strategy compared with a retirement planning. Depending on the goal you seek to achieve should determine the fund you choose. If you choose a wrong plan for the different term, you will suffer. I know some people might be thinking, if mutual funds are this volatile, or if it is susceptible to inflation, how is it different from my savings account? A savings account is mainly for storing money. A mutual fund is designed to invest your money. An example is emergency money you need next week. A savings account may make sense. Money you want to grow for 5 to 10 or 20 years. An investment vehicle like a mutual fund may be worth considering. Before I go, I cannot talk about mutual funds without telling you how to start investing in it. But before you invest, here are a few steps to consider. Know your goal. Why are you investing in the investment you are planning to? Are you investing for retirement, buying lands, education, or starting a business? Know that first. Step number 2, research licensed funds managers. Don't just go and choose any fund manager. Research into them. Understand their investment strategy, their fees, their historical performance, even their withdrawal conditions. Step number 3, start consistently. You don't need to wait until you become rich. The goal is to develop the habit of investing. So start and be consistent. No matter how small the money, 300 cedis, 500 cedis, you can invest. When you know your goal, you choose the way you plan to invest to. The biggest difference between people who build wealth and those who struggle financially is often not income. It is what they do with the money they earn. A mutual fund will not make you rich overnight. If you are looking for a get-rich-quick scheme, mutual funds are not for you. But it can be a powerful tool for disciplined investors who want money working towards their future. The question is not how much money do I have today. A better question is, Am I building a system where my money grows over time? If you want to learn more about investing in Ghana, subscribe to Money Code Africa. Follow us on all social media handles because we break down the financial principles Africa need to build long-term wealth. I'll see you in the next video.